Hello everyone, this is ACCA Amit Kumar and we'll discuss Ind AS 21 the effects of changes in foreign exchange rates. Now when we are dealing with various transactions, there are transactions which we are dealing in the functional currency, but there are some transactions which are not in functional currency. So the management is exposing the entity to foreign currency exposure risk. So the entity is required to convert these foreign items on the date of transaction. If it is a monetary item, they are also required to convert it on the date of reporting. Settlement is after the date of reporting. It is also converted on the date of settlement. In some cases, the date of settlement is before the date of reporting in case of liabilities. Then we simply need to convert that foreign item on the date of transaction and on the date of settlement. In case of assets, if it is a non-monetary asset, it is converted on the date of transaction on the reporting date, because non-monetary asset is already converted into functional currency and is now either being amortized or being depreciated. But if it is a non-monetary asset which in future can be measured at fair value, it gets measured at fair value if we are using the revaluation model, and the revalued amount is based on foreign currency. Then we may need to convert this on the date of remeasurement at fair value in a foreign currency as well. So the first and the foremost thing which is required in the effects of changes in foreign exchange rates is the term functional currency. Functional currency is the currency in which the entity is functioning. Mainly it is the sales price, the currency in which sales price of goods or services is denominated. Or it is the currency which influences the prices of goods or services. Or the currency in which majority of the costs are incurred So functional currency is not an accounting policy choice. Functional currency is determined, it is assessed on the basis of primary indicators. So we'll first look at these three primary indicators. This will help us in knowing the functional currency. If these three financial indicators do not help us in knowing the functional currency, the additional factors like the currency in which entity is financed, the currency in which entity retains funds or remits to parent. So these additional factors are taken into consideration to determine the functional currency. Once the functional currency is determined, once the function is determined, any other currency is foreign currency. In a layman's language, we can say that what is easier for an accountant to convert? If the majority of the transactions are in dollars, and sometimes there are transactions happening in INR. The majority of the transactions, the sales prices of goods, revenue, costs are being incurred in dollars and in the Australian dollar. What is easier for this accountant to convert? Whether to convert dollar into INR. Suppose we are based in India, we may think that since we are based in India, the functional currency should be INR, so we should convert every line item, every revenue item, every cost item which is denominated in dollar in INR simply because we are based in India. Let's be a little practical and understand if this is thousands or lakhs of transactions which is happening in dollars, which is easier to convert? The some foreign currency items which are less in number in comparison to these thousands or lakhs of transactions is easier to convert. Is the reason we focused on the currency in which sales prices are denominated, the currency in which the cost is being incurred, the currency which influences the price, were the primary indicators for knowing the functional currency. Then we looked at additional factors. If these were not easily, this information was not easily available, is the reason we looked at the additional factors to know what is the functional currency. As I said, from a layman's perspective, if I'm looking for an easy way out to prepare financial statements, the accountant's life is easier if they convert INR into dollar, if they convert this pound into dollar, if they convert this Australian dollar into dollar, because we had to convert only 3 transactions. We had to convert 3 transactions, and we were successful in preparing our financial statements into dollar. Now, if being in India, if we are required to present in INR, that is an accounting policy choice, or that is a regulation which is wanting us to present financial statements into INR. The difference between these two stages, one is simply conversion of an item, conversion of an item. Now, someone may argue that why did we get into these foreign transactions? So management is responsible for exposing the entity to this foreign currency exposure risk. And if management is responsible, and if there is any exchange gain or loss on converting these items into functional currency, the exchange gain or loss is charged to profit or loss account. So these are the transactions happening. These are the transactions being done by the entity. This is the functional currency decided by the entity. Then when we convert this, any currency other than functional currency. Now if the functional currency determined, like it is not an accounting policy choice, functional currency is not an accounting policy choice, it is determined on the basis of primary and secondary indicators, which helps us into identifying the functional currency. Once a functional currency is determined, suppose in our example the functional currency is dollar. Now any currency other than dollar, even if it is INR, it is foreign currency. We'll need to convert it into dollar. If it is pound, it is Australian dollar, Canadian dollar, Swiss franc, dinar, dirham, whichever currency, any other currency other than dollar is foreign currency for this entity. In India, though 99% of the entities had INR as their functional currency, but there were still 1% entities which had different currencies other than INR as functional currencies. So in my example, you can think that this is those 1% company which is having dollar as their functional currency in spite of being based in India. So we have been successful in converting the financial statements into dollar, into the functional currency, or as a layman we can say the currency in which I am functioning, the currency in which the entity functions day to day. It's easier for them to prepare financial statements in the functional currency. Currency and presentation currency are same, but in this case, suppose the regulatory requirement in India wants that we need to present these financial statements on the basis of INR, or for the purpose of consolidation if the parent is an Indian entity, and for the purpose of consolidation we need to present these financial statements into INR for the purpose of consolidation. So presentation is an accounting policy choice. If we are preparing consolidated financial statements, we may need to convert these financial statements into INR to facilitate preparation of consolidated financial statements. The regulatory requirement in our home country may want us to present these financial statements or file in INR, so the presentation currency may be different. The presentation currency may be different. Now when we convert this INR, this dollar into INR, we are converting the entire financial statements into INR. If there is any exchange gain or loss, who is responsible? When the management does transactions into foreign currencies, they can be held responsible for any exchange gain or loss resulting from them. But when we are translating the financial statements from one currency, which is a functional currency, to presentation currency, if there is any exchange gain or loss, can we blame the management for it? Who is responsible for it? Translation of financial statements. Whom can we blame? Translation of financial statements. Now if you look at there's a difference between these two stages. One was conversion of an item. One is conversion. One is translation of financial statements. Conversion of an item and translation of financial statements. We are translating the balance sheet. We're translating the income statement. That means we're translating the assets, liabilities, equity, income and expenses, the 5 elements. We're translating into a different presentation currency. We are converting an item. Only the item which is dealt with in foreign currency is converted into functional currency. So in the first stage, we have to convert all the foreign items into functional currency. Once we are done with conversion of all foreign items into functional currency, if the presentation currency is different, then we move on to the next step. The first thing is to convert foreign items into functional currency. The second step is, if the presentation currency is different, then we move on to the second step. So exchange difference relating to conversion of an item is taken to P&L. The exchange differences on translation are taken to OCI, other comprehensive income. The exchange differences on translation are taken to other comprehensive income. So when we are converting an item, that exchange gain or loss is treated as a realized gain or loss. When we are translating the financial statements, this is treated as an unrealized gain or loss. Though on disposal of a foreign operation, the foreign currency translation reserve, that is FCTR, to it is reclassified to profit or loss account. Among the items of OCI, foreign currency translation reserve is one of the items which is presented as part of OCI, and OCI is further bifurcated, which can be reclassified to P&L, the items which cannot be reclassified to P&L. So among the items which can be reclassified to P&L, foreign currency translation reserve on disposal of a foreign operation is an item which may be reclassified to P&L on disposal. And on first time adoption of IFRS Ind AS, there is a facility provided by optional exemptions in relation to foreign currency translation reserve, then it can be reset to zero. If you are applying Ind AS for the first time or IFRS for the first time, foreign currency translation reserve can be reset to zero. This is a facility provided. Now when we are dealing with converting an item, we may deal with monetary items or non-monetary items. Monetary items or non-monetary items. Monetary items are fixed number of determinable number of units. Fixed number of determinable number of units means that suppose there is a machine bought for $10,000 and this machine is not paid for. So this is to be converted on the date of transaction. Date of transaction is July 1st, 2019, when the exchange rate was $1 is equal to 60. And since the functional currency was INR and $10,000 was a foreign item, so the machine was initially recorded at 60 into 10,000. 6 lakh is the amount of machine and a liability recorded at an amount of 6 lakh. So in this transaction, the monetary item is this liability. Non-monetary item is the machine. The liability is initially recorded on the date of transaction at 6 lakh. Machine is also recorded at the same amount. Machine is having a useful life of 5 years. It will be normally depreciated on the basis of 5 years, and the machine's value on the date of reporting on 31st March 2020, that is the date of reporting, machine will be recorded at 6 lakh minus depreciation till date. So this non-monetary item is only converted on the date of transaction. We will not be converting it on the reporting date because there is no need to convert it. We have converted the machine into our functional currency. We have converted it into INR, that we bought the machine for 6 lakh INR. That is the functional currency in which we are recording the value of the machine. But as far as the liability is concerned, the liability needs to be recorded on the date of transaction, and if the date of settlement is before the reporting date, we'll settle it before the reporting date and will pay according to the exchange rate on the date of settlement. But I assume the date of settlement to be after the reporting date. Suppose the date of reporting, on the date of reporting, it is fixed number of determinable number of units, that is $10,000. Exchange rate on 31st March 2020. $1 is equal to 65 INR. The amount to be settled now is 65 into 10,000. 6,50,000. So the liability is already recorded at 6 lakh in INR. The liability amount needs to be increased to 6,50,000. So loss on conversion of a foreign monetary item account debit 50,000, credit liability account 50,000. So the liability recorded on the date of balance sheet on 31st March 20 is equivalent to 6,50,000 now. The liability is recorded at an amount of 6,50,000. It increased from 6 lakh to 6,50,000. That is the date of reporting. Is the reason monetary items are converted on the date of transaction, they are converted on the date of settlement. If the settlement date is after the date of reporting, we need to convert them on the date of reporting, the exchange the P&L. Also on the date of settlement, we need to convert them on the date of settlement. Any resulting exchange gain or loss is taken to P&L. In case of non-monetary items, they are converted only on the date of transaction. Non-monetary items converted in functional currency on date of transaction or converted if measured at fair value. Now if they are measured at fair value, they may be measured in a foreign currency denominated amount. If they are measured at fair value in a foreign currency denominated amount, we need into functional currency on the date of remeasurement at fair value. Now, if you are using revaluation model, in case of revaluation model, if it is first time revaluation, we create a revaluation reserve, and this revaluation reserve forms part of other comprehensive income. Now, if this first time revaluation happens in a foreign currency, we'll need to convert this into functional currency, and this functional currency amount or converted amount is a revaluation as part of other comprehensive income. If the first time revaluation is downwards, and if that downward value is denominated in a foreign currency amount, we need to convert it on the date of revaluation into functional currency, and if first time revaluation is downwards, we need to charge it to profit and loss account. Subsequent revaluation will depend on what happened first time or what is the current situation. If subsequent revaluation is following an upward revaluation, that we already have a reserve and subsequently there is a fall. If we already have a reserve and subsequently there is a fall, first we'll consume the reserve, any excess will be taken to P&L. First time revaluation so the difference was taken to P&L, and subsequent revaluation if it is upwards. So we'll first reverse the charge to P&L, and any excess we can create a reserve. So in case of a revaluation model for a non-monetary asset which is revalued, if revaluation is done in foreign currency amount, we'll need to convert it into functional currency wherever the difference revaluation reserve or it is routed through P&L. The exchange difference is also routed through P&L or through revaluation reserve. If it is inventory valuation, inventories are measured at lower of cost or NRV. NRV may be denominated in a foreign currency. Now, for comparison, we need to compare it with the cost. The NRV needs to be remeasured. If it results in any loss to be charged to P&L, if NRV is lower than the cost, then the exchange difference will also be charged to profit and loss account. So in normal circumstances, non-monetary assets are not converted except the date of transaction, but if they are converted after the date of transaction, they will be converted only if they are measured at fair value. Monetary items, whether assets or liabilities, are converted on the date of transaction. Monetary items are converted on date of transaction. Converted on date of reporting. Converted on date of settlement. So if it is loan receivable, that may be a monetary item. If it is denominated in a foreign currency, we'll need to convert it on the date of transaction. We'll need to convert it on each reporting date. We'll also be converting it on the date of settlement. If the settlement date is before the reporting date, then we do not have any foreign currency item on the date of reporting. So we'll not have anything to convert it on the date of reporting. Now in this example, we bought this machine and we not paid for it. We converted it on the date of transaction. We also converted it on the date of reporting and have recognized the exchange loss. On date of settlement, now if you notice that this is fixed number of determinable number of units. Fixed number 10,000. Determinable number of unit is no matter what the situation, we'll need to pay $10,000, whatever the exchange difference. The liability on the date of settlement. Suppose it was settled on 10th May 2020. When $1 is equal to 50 INR. If $1 is equal to 50 INR, then $10,000 will be converted into 55 lakh. So the liability which was standing at 6,50,000 is settled by paying only an amount of 5 lakh. On settlement, the entity has gained out of exposure to foreign currency risk. This has turned out to be a benefit, that they've benefited out of it. And if they get benefited out of it on settlement, the entry done by them is cash account credit 5 lakh, liability account debit 6,50,000, the difference of 1,50,000 is the gain on settlement, which is credited to P&L account. So it was a loss of 50,000. It was supposed to be settled at 6 lakh, 5 lakh. So there is a gain of 1,50,000 on the date of settlement. So this is how we deal with monetary and non-monetary items on conversion of foreign items into functional currency. When we translate the financial statements, translation of financial statements. Converting the financial statements from functional currency to presentation currency. So when we are converting the balance sheet items, assets, liabilities are converted at the closing rate on date of reporting. Liabilities are converted at closing rate on the date of reporting. Equity on average rate. Income statement income and expenses are converted on average rate. If the transactions are very few, you can use the actual rates. But if the transactions are large in number, it's better to take an average rate because the exchange rate keeps on fluctuating every day. So we can use the average rate to translate the financial statements into functional currency, from functional currency to presentation currency, and the exchange difference on translation of financial statements on translation of financial statements is taken to other comprehensive income. Among the items that may be reclassified to profit or loss, foreign currency translation reserve on disposal of a foreign operation so this is presented as foreign currency translation reserve FCTR. So the foreign currency translation reserve is presented in other comprehensive income as items which may be reclassified to P&L. Since foreign currency translation reserve relating to a foreign operation on disposal of foreign operation is reclassified to P&L. Another thing which is also available for foreign currency translation reserve is when we are implementing Ind AS or IFRS for the first time, among the optional exemptions available under Ind AS 101 first time adoption of Ind AS, any foreign currency translation reserve can be reset to 0. This is the facility available under first time adoption of IFRS Ind AS. Among the optional exemptions for applying the effect retrospectively, the foreign currency translation reserve can be reset to 0. So this is how we deal with the effects of changes in foreign exchange rates. If you're using these foreign currency exposures in case of hedge accounting, then the principles of Ind AS 109 financial instruments hedge accounting becomes applicable. In all other circumstances, the foreign currency risk of conversion of foreign items is dealt with under Ind AS 21, the effects of changes in foreign exchange rates. Let's summarize it. So how do we report these foreign currency transactions in the functional currency? So the foreign currency transaction is initially recorded by applying the spot exchange rate on the date of transaction. Suppose $1,000, and if the rate is 60 INR, then it is recorded at 6 lakh. Initially, the liability is recorded at 6 lakh. And if the date of settlement is 30th October, then on the date of settlement will again convert it. Any resulting gain or loss is recorded as part of profit and loss account. Suppose on the date of settlement, the rate is $1 is equal to 65, and if it is $10,000, then 6,50,000 is supposed to be paid on the date of settlement, resulting in a loss of 50,000, which is charged to P. There's a mistake in this, that there is 1 0 less. It is 6 lakh and 6,50,000. So the entity will settle the liability which was recorded at 6 lakh, but will be required to pay 6,50,000. So we'll record a loss on settlement of 50,000. Then we deal with monetary and non-monetary items. How to deal with them? So monetary items are fixed number of determinable number of units which have a fixed exchange value unaffected by inflation or deflation. Suppose the liability of 10,000 is fixed number or determinable number of unit. The settlement of the liability will also be in this fixed number, that is $10,000. Monetary assets can be cash and accounts receivables. Monetary liabilities are loans which are required to be settled in a fixed number of determinable number of units. So the exchange rates applicable to them on each reporting date will need to be converted. So the monetary items are converted at the closing rate. So on each reporting date they are required to be remeasured. Suppose this $10,000 liability is remeasured on date of reporting as well. Non-monetary items are not determined in fixed number of determinable number of units, and they cannot be readily converted into cash, like fixed assets, as well as intangible assets such as goodwill are converted only on the date of transaction. The exchange rates applicable to them at the end of each reporting date is non-monetary items that are measured in terms of historical cost in a foreign currency shall be translated using the exchange rate at the date of transaction. Like we bought this machine for $10,000, is recorded at 6 lakh, normally depreciated, no effect of exchange rate. Non-monetary items which are measured at fair value in a foreign currency, they will be translated using the exchange rate at the date of fair value measurement. When we measure them at fair value, the exchange rate applicable to them on the date of this remeasurement at fair value is taken to P&L, and if it is a revaluation model, if the difference is taken to OCI, we'll be taking the difference fair value denominated in foreign currency, we convert it into functional currency and take the difference to P&L or OCI. So this machine bought at $10,000 is revalued in dollars. The fair value of the machine is $11,000. So this remeasurement is in foreign currency, so translated using the exchange rate on the date of revaluation. So we'll use that rate, compare it with the existing value in functional currency, this new value determined on the date of transaction or on the date of remeasurement in functional currency. We compare, and wherever the difference is taken, whether it is taken to P&L or OCI, we'll take the difference. So this is the summary of it. If it is asset, it is translated at the date of transaction. Date of reporting will translate it at the closing rate. If it is a monetary liability, we'll translate it at the date of transaction, date of reporting, and at the exchange rate on the date of settlement. If it is a non-monetary asset measured at historical cost, we'll convert it on the date of transaction. No translation is required thereafter. Will not translate it on the date of reporting. It is normally depreciated, not affected by any exchange difference. If it is a non-monetary asset measured at fair value, then we'll convert it on the date of transaction at the spot rate, and we'll convert it at the date it is remeasured at fair value. So how to record these foreign currency transactions if the settlement date is after the reporting date? If the settlement date is after the reporting date, the entity is remeasured on the reporting date. The difference is taken to P&L. On the date of settlement, the resulting gain or loss is also taken to P&L. Suppose the machine was bought for $10,000. The exchange rate was $1 is equal to 60, resulting in a 6 lakh of machine being recognized on the date of transaction. On the date of reporting, it was remeasured at 6,50,000. So this is in line with the example I shared with you. There is a loss of 50,000 recorded. On the date of settlement, it was settled for only 5 lakh. So the settlement gain was equivalent to 5 lakh, resulting in a gain of 1,50,000 recognized. Since the liability was recorded at 6,50,000, increasing from 6 lakh, on the date of reporting, 50,000 loss was recognized. On the date of settlement, 1,50,000 gain was recognized. It was supposed to be settled at 6 lakh, but actually settled at 5 lakh finally on the date of settlement. So monetary items are converted on the date of transaction, converted on the date of reporting, and again converted on the date of settlement. The resulting gains or losses are taken to P&L account. So the machine, please read this as 6 lakh. Machine is initially recorded at 6 lakh. Bought this for 6 lakh. There is no impact on the machine, which is a non-monetary asset, but liability is a monetary item. So we converted on the date of reporting at 6,50,000. So when we recorded it at 6,50,000, we recorded a loss of 50,000 and increased the liability by 50,000. So the liability which was recorded at 6 lakh INR increased to 6,50,000, like this. So this is the correct entries. The items displayed now were having 1 0 less. So $1 is equal to 60, $10,000 is equal to 6 lakh. On the date of reporting, they increased to 6,50,000. There was a loss of 50,000 charged to P&L, and the liability increased by 50,000. So the liability balance increased from 6 lakh to 6,50,000. On the date of settlement, the liability was settled at an exchange rate of $1 is equal to 50. That means entity had to pay only 5 lakh INR to settle this transaction. Had to pay only 5 lakh INR, and the resulting gain was 1,50,000. So this is how we deal with the effects of change in foreign exchange rates. So the most important thing was, and if we look at from a layman's perspective, the most important thing was determining the functional currency. And functional currency is not an accounting policy choice. It is determined on the basis of primary indicators and secondary indicators. The primary indicators are the currency in which the sales prices of goods and services are denominated, currency which influences the price, or the currency in which the costs are incurred. If this doesn't help, then we look at currency in which entity is financed, currency in which entity retains funds or remits funds to parents. These help us in determining the functional currency. What is the role of it? The role of it is to minimize the effort and present fairly the financial statements and deal with the effects of changes in foreign exchange rates. So if our primary economic environment is dollars, so in spite of being in India, it may happen that our functional currency may turn out to be dollar in spite of wherever we are located. So it's not on the basis of the country you're located in, but mostly the country you're located in determines the functional currency. But I shared it earlier as well that in India, 99% of the cases, the functional currency is INR, but still there is 1% situation wherein the functional currency is not INR and there is a foreign currency which is acting as a functional currency for these entities. So in my example, I had taken dollar as a functional currency. So if you look at from a layman's perspective as well, if you are dealing with lakhs of transactions, which currency is easier for you to convert? The currency which is small in number or the currency which is large in number? It's obvious the currency which is small in number is different, and there is a currency which is pre and the majority of the transactions are in that currency. It makes no sense to convert the currency which in which we are transacting in large numbers, and that is the main currency, which is the functional currency, the currency in which we are functioning, in which we are operating. If the presentation is required to be done in a different currency, we'll do that later. First, let's sort the effect of change in foreign exchange rates as far as the functioning of the entity is concerned. So we determine that the functional currency is dollar. So any currency other than this functional currency is foreign item. We need to convert it on the date of transaction, on date of reporting, and on date of settlement. This conversion will result in foreign exchange gain or loss. That foreign exchange gain or loss is taken to P&L. As far as presentation is concerned, the presentation currency may be different. Presentation currency is an accounting policy choice, or may be required for the purpose of consolidation, or may be required for filing on the stock exchange, required by law. So when we're translating the financial statements, we cannot blame the management for the resulting loss on translation of financial statements. We will not be giving credit also for any exchange gain on translation of financial statements. So in translation of financial statements, we convert the balance sheet, we convert the income statement, we convert the balance sheet items, assets, liabilities on the closing rate, equity on the average rate. Income statement items, income and expenses are converted on the average rate, and the difference is taken to other comprehensive income. And we'll be successful in presenting the functional currency into presentation currency INR. Now, disposal of a foreign operation, this foreign currency translation reserve recognized in other comprehensive income may be reclassified to P&L and is recorded among items which may be reclassified to P&L. And as I shared on first time adoption of Ind AS, under Ind AS 1, first time adoption of Ind AS, there is a facility given among the optional exemptions that the foreign currency translation reserve, since it is an unrealized gain or loss, may be reset to zero. So this is how we deal with Ind AS 21, the effects of changes in foreign exchange rates. So with this, I come to the close of the session. If you have any doubts, you can be in touch. You can also my courses on Unacademy with the name ACC Amit Kumar, and to subscribe to any course on Unacademy to get the maximum discount, you can use the code ACC Amit. ACC Amit is the code to get instant discount on subscribing to any course. So next month I'll be sharing the insights on financial reporting issues based on Ind AS, and we'll be sharing a quick summary insights which I've gained in the last 10 years and had also published it through my book on Ind AS known as Ind AS Concepts in One Day. So I'll be sharing the insights in a crisp manner which will be relevant and to the point, which will save your time, and you'll be able to utilize that knowledge to be able to pass easily in the examination. Even if you go through these last minute revision sessions, through special classes, through the YouTube sessions, through the live classes going to happen in the next month, which are targeting each and every standard in the crash course on financial reporting. And also there is a discussion on the complex accounting standards like share-based payments, financial instruments, employee benefits, consolidation. And I also shared consolidation in 5 steps through which you can easily secure marks in the examination by having a control on the question. So this is all for the day. Thanks for your valuable time.